If you have been working a W-2 job, running a business, or building a rental portfolio while watching your tax bill climb every year, this video is going to change how you think about real estate. Not just as an investment, as a tax strategy. I'm Ellie, the DSCR Pro, and today I am going to walk you through the real tax benefit of owning rental real estate, including one real estate tax loophole that can cut your taxable income by tens of thousands of dollars. We're also going to talk about what most people get wrong and how the right financing strategy unlocks the full power of this benefit. Here is what we are covering today. First, how real estate depreciation works and why it is the single most powerful tax tool available to real estate investors. Second, the short-term rental loophole. This is the one most people don't know about, and it is completely legal. Third, cost segregation. How some investors wipe out their entire taxable income in year one. And fourth, this is the part I really want you to stay for, how your financing structure affects every single one of these benefits. Stay until the end because I am going to share something that surprised most of my clients when they first hear it. The type of loan you use to buy the property determines whether you can actually keep these tax benefits and real estate tips working for you long term. Let's get into it.
Let's go!
Let's start with real estate depreciation because this is the engine behind every tax strategy I am going to share today. Here is what the IRS is telling you. When you buy a rental property, the building losses value over time due to wear and tear. So they allow you to write off that building value as an expense, even though you're not actually spending that money out of pocket. It is what accountants call a phantom expense. You get the deduction without the cash leaving your bank account. For residential real estate, single-family homes, duplexes, small multifamilies, the IRS lets you depreciate the building portion over 27.5 years. Commercial property is 39 years. Here is a simple example. You buy a rental property for $500,000. You allocate 80% of that to the building, $400,000. Divide that by 27.5 years. And you get a real estate depreciation deduction of roughly $14,500 every single year. You never write a check for that. It just reduces your taxable income. Now, here is why this real estate tip matters even more when you are cash flowing. Let's say that same property brings in $3,800 a month in rent, $45,600 a year. After your mortgage, interest, property taxes, insurance repairs, and management fees, let's say you have $35,000 in real deductible expenses. Add the depreciation, now you are at nearly $50,000 in total deduction. Against $45,000 in rental income, on paper you lost money. In reality, you made cash flow every month. That is the magic of this tax strategy. The IRS says you are losing money. Your bank account disagrees. Now let's talk about the real estate tax loophole that changes everything, especially for investors who have W-2 job or run a business. Here's the problem most landlords run into. The IRS classify rental income as passive income. That means if your rental property generates a tax loss, even that $14,500 real estate depreciation loss, you can usually only use that loss to offset other passive income. You cannot use it to reduce your W-2 income or your business income. It just sit there unused, carrying forward to future years. This is the limitation that drives most investors crazy. They have a great property, they have a real loss on paper, and the IRS won't let them use it where they actually need it. Enter the short-term rental loophole. Here is how this real estate tax loophole works. If the average guest stay at your rental property is 7 days or less, the IRS does not classify it as passive income. It is treated as active income, which means the losses can offset your W-2, your 1099, even your capital gain for selling stocks or other investments. Think about what that tax strategy means in practice. You're an executive making $250,000 a year. You buy a property, convert it to an Airbnb, generate $50,000 in rental income. After all your expenses, including depreciation, you have a tax loss of $105,000. Without the short-term rental loophole, that loss just flowed. With it, you subtract $105,000 from your $250,000 income. Now you're taxed on $145,000. You just saved somewhere around $35,000 to $40,000 in federal tax in 1 year. The rule that unlocks this short-term rental loophole, you need to materially participate in managing the property. The IRS has several tests for material participation, but the most practical one is the 100-hour test. You spend at least 100 hours managing the property annually, and you spend more time than anyone you hire to help. That includes cleaning crews, maintenance working, anyone on your payroll. If you are managing your own Airbnb and doing it actively, most investors clear that threshold easily. Now, let's take it one level higher, because the real estate depreciation benefit we just talked about, you can accelerate it dramatically with something called a cost segregation study. And this is one of the most powerful real estate tips I can give any investor who is buying a property this year. Here's the concept. Not everything in a building depreciates over 27.5 years. The carpets, appliances, light fixture, flooring, furniture, these are considered non-structural components, and they have shorter depreciation schedules. 5 years, 7 years, 15 years. A cost segregation study done by a specialized accounting and engineering firm breaks your property down component by component. It identifies what depreciates faster and front loads your deductions into the early years of ownership. The result, instead of taking $14,000 a year in depreciation, you might take $70,000, $80,000, even $100,000 in depreciation in year one alone. That is not a loophole. That is a completely legal IRS sanctioned tax strategy that most investors simply don't know they're entitled to use. For multifamily properties, this real estate tax strategy is especially powerful. There are more depreciable components in an apartment building than almost any other property type, and cost segregation allows you to recognize all of that value up front. One real estate tip I want to be clear about: this requires working with a qualified tax professional who understands real estate investing, not just a general accountant who files returns. The right advisor makes the difference between leaving tens of thousands of dollars on the table and actually capturing the full benefit. Here is where most investors and most lenders miss the connection. And this is the real estate tip that could be worth more to you than anything else in this video. Every tax strategy I just described, real estate depreciation, the short-term rental loophole, cost segregation, they all depend on one thing: you actually owning the property. And the barrier most investors hit when trying to acquire these properties is the financing. Traditionally, banks require W-2 income verification. They want 2 years of tax return. They want to see every deposit, every write-off, every dollar that passed throughout your account. And here is the cruel irony: the better you have been at using real estate tax strategies, writing off expenses, using depreciation, running your investment through an LLC, the worse your tax returns look to a traditional bank. The very tax strategy that makes real estate powerful is the same strategy that gets your loan application denied. I had a client, Franklin Rodriguez, who spent 5 months going back and forth with another lender. They kept moving the goalposts, different requirements every week, more documentation, higher down payment, requests at the last minute. He was stuck, the deal was in jeopardy, and he was watching an opportunity disappear in real time. We stepped in, got him approved, and closed in less than 30 days. Because at DSCR Pro, we don't qualify him based on his tax returns, we qualify based on the property rental income. That is exactly what a DSCR loan does. Debt service coverage ratio. The property qualifies, not the person. We look at one thing: does the rental income on the property covers the mortgage payment? If the answer is yes, we can move forward, regardless of what your personal tax return shows. No W-2 required, no tax return, no pay stub, no explanation for why your adjusted gross income looks low because you are running a real estate portfolio the right way, using every legal tax strategy available to you. DSCR loans are specially designed for investors who are already doing what we just talked about in this video. Self-employed investors, portfolio builders, Airbnb operators using the short-term rental loophole, people who are growing a real estate business and using the tax code the way it was intended. Let me connect these real estate tips one more time, because this is the part that changes how investors think about building a portfolio. The tax benefits of real estate are most powerful when you are acquiring cash flowing properties consistently. Each new property brings a new real estate depreciation schedule. Each cost segregation study creates creates new deduction. Each short-term rental loophole property creates new active losses. The tax strategy compounds as your portfolio grows, but you can only acquire properties if you can get the financing. And if every acquisition requires you to document your W-2s, fight for your tax returns to look a certain way, or slow down for a traditional 30 to 45 days bank process, you're going to miss deal. You're going to lose momentum. You're going to watch other investors move faster while real estate tax strategies sit unused. I think about Atanda Olabi, one of my clients. He's a nurse who has been building a portfolio one property at a time. Third loan with us. He told me, after 25 years of working, I finally feel like I am building wealth. Each DSCR loan he closes opens up a new property with a new depreciation clause, new cash flow, and new tax benefits stacking on top of each other. That is a real tax strategy that actually scales. That is the real estate tip most people need. Get the financing right and the tax benefits take care of themselves. At DSCR Pro, we work with 30 plus lenders across 48 states. We can pre-qualify you in 24 to 48 hours based on your property's income, not your personal income. And we close in approximately 4 weeks. No surprises, no moving the goalpost. Right before closing day, just a straight answer and a fast close. Here is what to take from this video. 1. Real estate depreciation is your foundation. Every rental property is generated. Make sure you're tracking it properly on Schedule E with a tax professional who understands real estate. 2. If you have a W-2 job or business income and you want to use real estate losses to offset that income, look seriously at the short-term rental loophole. Average stay of 7 days or less plus material participation, and those passive losses become active. 3. If you are buying a larger property or multifamily, ask your accountant about the cost segregation study. The upfront deduction from this tax strategy can be significant. 4. And most importantly, make sure your financing strategy supports your acquisition pace. If traditional banks are slowing you down or turning you down because of how your taxes look, DSCR loans exist precisely for that situation. You have got the tax benefits. Now the real question is how to turn that into income. Watch how to start an Airbnb business next to see how investors set it up the right way so they can protect cash flow and avoid expensive beginner mistakes. If you found these real estate tips helpful, hit that like button and subscribe. I cover real estate financing, DSCR loans, and tax strategies every week on this channel. And if you are ready to take action, whether it is your first property or you're adding to a growing portfolio, call or text me directly at 718-300-3503. The DSCR Pro team will pre-qualify you immediately, and we can get you approved in 24 hours when you already found your property. No tax return, no runaround, no surprise requirements of closing. I'm Ali, the DSCR Pro, and I help you turn today challenging into tomorrow positive cash flow.